Doug at Community Lending Group. Now, whether you're a first-time home buyer or a long-time homeowner, you're going to come across the term an escrow account. Now, what exactly is an escrow account and how does it affect you? So for today's mortgage moment, we're going to discuss just that. Now, an escrow account is used to facilitate a real estate transaction. It's a financial agreement where money is held by a third party in behalf of two other parties. Now, there's two different types of escrow accounts that you'll encounter when buying or owning a home. There is a purchase escrow account and also a mortgage escrow account. So let's get started with the purchase escrow account. So let's say you're buying yourself a new home. You're required to pay an earnest money deposit right after going under contract, and then you're required to pay the down payment and even the closing costs before you ever get the keys to your home. Now, you want to make sure your money's safe. This is the purpose of the escrow account. It protects both the buyer, the seller, and even the lender. It uses an independent third party, typically a title company, which will establish an account to hold the funds until all the stipulations of the contract are met. Now, once they're met, title then disperses all the funds from the escrow account to all the parties involved in the transaction and then closes the account. Now, this process ensures you the peace of mind to know that your money is safe while the financing of your home takes place. Now, the second type of escrow account is a mortgage escrow account. This is set up by the lender at closing to collect funds for the required monthly fees such as taxes and insurance. Now, at closing, your annual insurance premium is paid in full as part of normal closing costs. In addition, funds are set aside to pay taxes whenever they are due in your state. Plus, the lender will require an additional 2 months of taxes and insurance premiums to be collected to help establish this escrow account. Then each month, as you pay your mortgage, part of that payment will go to build up the escrow account. So when your taxes and insurance premiums are due, the lender will pay them in your behalf with the funds that have been building in your escrow account. Now, an escrow account is typically required by the lender when you have less than 20% equity in your property or you have a government loan such as an FHA or a VA loan. Now, most lenders require an escrow to ensure that your taxes and insurance are being paid on time, thus avoiding any tax liens or lapse in insurance coverage. Now, if you have more than 20% equity, you can choose to waive your escrows and not have them collected by the lender. But then you have to be responsible to make sure that they are paid and they're paid on time. Now, the escrow account is reviewed annually to ensure that there's no more than a 2-month cushion remaining in your escrow account. Now, if the cushion's too high, the lender is required by law to issue you a refund. On the other hand, if the balance is too low due to an increase in either your insurance premiums or your taxes, the lender will require this to be adjusted with either a one-time payment from you, an increase in your monthly payment, or even both. That's why your payment might increase even though you have a fixed interest rate. If you have any additional questions about an escrow account and how it works, feel free to give me a call. This is Doug with Community Lending. Thanks for watching, and I look forward to talking to you real soon.